To what extent could tomorrow's CPI report validate or poke a hole in that narrative?
Well, thanks for having me on, Scarlett. It's good to be here with you. I think that tomorrow's CPI report is very likely to show a few things, that we probably saw some monthly increases in inflation, but that year on year, the big headline CPI number that was 6.5% last month is likely to be lower. Our expectation is that it's going to be 5.9. We also expect that core CPI, which had been 5.7, is likely to be lower, likely to be 5.3. So those are lower, which is great. That's disinflation. But those are also really big numbers. We're still a lot higher than the Fed's 2% target.
Certainly so here. And this idea that no one, I think, expected, Jason, that this would sort of be a linear path down, that this would just kind of be that slide that you see at the playground, the idea that you're going to have a few ebbs and flows here ultimately. Are you still confident in the longer-term trend that we are headed back down towards a lower inflation rate? I won't ask you to pin a number on it, certainly not 2%, but certainly something a lot better than 5-6%.
Yes, absolutely, Romaine. I think that by the end of the year, we could be in the 2.5 to 3.5% range, potentially by the end of this year. That would be, it's not unforeseeable that that could happen. There's a couple big pieces to this. One is energy prices. And even though oil prices, WTI is closer to $80 now, and it was closer to $70 just in mid-December, that's a pretty big rise recently. And we're going to have a big summer driving season, probably the biggest ever. But last summer, we saw wildly higher oil prices, right? Touching up towards $130 a barrel. So if we're thinking about oil prices right now at 80 versus that, right, we could see prices be down year on year. For nat gas, very similar situation, right? Where were we last year? Touching up towards $10. Now we're closer to $2.50, right? So we're a lot lower. Even if prices go up a lot from here, we might be down year on year. We could see similar things in agricultural commodities. A lot of this has to do with the ripples and the reverberations of Cold War II, the Russian war on Ukraine, that caused giant commodity bubbles everywhere and dislocations across commodity markets. Prices could still be high this year and yet still be down year on year significantly.
Yeah, that's a really important point. Thank you for pointing that out. So, Jason, when we're done with the CPI report, it'll be past us, and we know the Fed has another CPI report that it will be able to look at before the next FOMC meeting. But there's also a lot of other data points this week that you say will be just as important as tomorrow's report, including retail sales as well as housing starts.
Yeah, housing starts and building permits are really, really important. If you look back at the Q4 GDP report, the big negative drawdown came from a drop in residential fixed investment. That peeled 1.29 percentage points off of the final GDP number. 2.9% was that final GDP number for the advanced report. 2.9 is great, but it would have been almost 4.2 if housing had just been flat. So the housing numbers are going to be really important. We've seen mortgage rates come in a little bit. If housing is just flat going forward, the fact that we have such strong jobs numbers now, despite the headline-grabbing tech layoffs, we're going to see consumption potentially be pretty solid, and that's the lion's share of GDP.
Let's pivot real quickly here, Jason, to the manufacturing sector. And I'm wondering how much you're making out of some of these regional manufacturing reports and the contractions that we've been seeing there. Is that still a small enough part of the economy that we don't need to be too shaken up by it?
Well, manufacturing is usually a leading economic indicator of overall GDP growth. And if you look at the PMIs, like the ISM Manufacturing Index or the Chinese Caixin or the Eurozone Manufacturing PMI, those are all below 50. 50 is the break even. Those are showing contractions. You look right now, there's 3 series, 50's break even, so the aggregate's 150. That's below 150 right now. Global manufacturing is in recession right now. But if we look at some of the other data that we pull in from, for example, the material handling industry, what we see is new orders are down, but shipments are still positive. Why? There was such a big backlog over the last couple of years where manufacturers were playing scavenger hunt economics, trying to get the components they need, the commodities they needed, the people they needed, all of those things they couldn't get at once, and they had a massive backlog. So even though some manufacturing numbers are quite weak right now, many manufacturing companies still have a really big backlog to burn off, and that could help carry them through, even though we might see some further economic weakness and and a recession in earnings over the next couple of quarters.
Jason, very quickly, you often make forecasts on different asset classes, on specific assets. What's your most out of consensus call right now?
Well, I think this year we could see probably oil prices be quite a bit higher this summer. I do think for the yearly average for WTI, we could easily be in the $80 to $90 range. That would be quite a bit higher than we are now. It's a lot higher than we were just a couple months ago.
Yeah.
The biggest thing, though, I expect, with a lot of people having jobs, the job state is still strong. People with jobs are driving, probably gonna have the biggest summer driving season in history this summer. It's gonna be a lot of air travel as well.